The laws of crisis, protection for banks, not people. 1. The theater of reform. Every financial crisis produces the same script. Politicians preach about safety, bankers frown gravely, and laws are hurriedly passed under banners of protection. Yet the record is clear, such laws protect the banking system, not the public. The system is never broken, it is carefully rigged. Footnote. Post-crisis legislation typically shields banks while citizens absorb the losses. 2. Britain's Bank Charter Act of 1844. Presented as reform, the Act eliminated smaller competitors and granted the Bank of England monopoly power over issuing notes. Far from protecting depositors, it concentrated authority and secured the bank's dominance. The lesson: stability was reserved for the system, not for its participants. Footnote. The 1844 Act transformed reform into cartelization of currency. 3. America's National Banking Acts. During the Civil War, laws forced banks to purchase government bonds in order to issue notes. This created the illusion of a safer currency while in reality transforming banks into permanent government financiers. Debt monetization was rebranded as public protection. Footnote. U.S. banks became captive financiers of the state, with patriotic packaging. 4. Glass-Steagall and its quiet undoing. Born in 1933, Glass-Steagall separated commercial from investment banking to rebuild trust. For a time it restrained speculation, but it also stabilized confidence in the system without changing its essence. Decades later, lobbying gutted its provisions, setting the stage for yet another crisis. Footnote. Glass-Steagall reassured citizens while leaving core bank power intact. 5. FDIC insurance, comfort at a price. Deposit insurance promised safety for small savers. In practice, it destroyed market discipline. Depositors stopped scrutinizing banks, allowing reckless behavior underwritten by government guarantees. Risk was privatized upward, losses were socialized downward. Footnote. FDIC turned public trust into a subsidy for bank risk-taking. 6. The Emergency Banking Act of 1933. Framed as patriotic duty, the act seized Americans' gold and replaced it with paper money. Citizens lost hard assets, while banks and the state secured new control over the monetary system. The law's true purpose was consolidation, not protection. Footnote. Gold confiscation disguised as patriotism reinforced state bank power. 7. The crisis of 2008 and TARP. Mortgage-backed securities collapsed, destroying jobs, homes, and pensions. Yet the troubled asset relief program channeled hundreds of billions to banks. Citizens endured foreclosures and unemployment, banks were saved with taxpayer funds. Once again, the system met Wall Street. Footnote. In 2008, savers were sacrificed so banks could be stabilized. 8. Europe's austerity and the ESM. In Greece, Ireland, and Spain, governments guaranteed bank debts, then imposed austerity. Hospitals closed, pensions shrank, but foreign creditors were paid in full. The European Stability Mechanism institutionalized this pattern, creating a permanent bailout fund for banks under the guise of citizen protection. Footnote. European stability meant rescuing creditors while hollowing out public life. 9. Basel Accords and regulatory theater. Global banking rules such as the Basel Accords promise safeguards against risk. In reality, they gave banks tools to reclassify liabilities, shift assets off balance sheets, and exploit government guarantees. Protection was offered in speeches but delivered only to institutions. Footnote. Basel Accords created more loopholes than guardrails. 10. The modern pattern. Whether through interest rate hikes, bailouts, or restrictions on private money, Today's laws follow the same principle: preserve the financial order at all costs. Citizens are reassured with slogans, while banks receive structural guarantees. To survive, one must ask the essential question: who benefits? Footnote: Financial laws safeguard the system itself, not individual savings.